You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
One thing I'd like to say is that I've met a number of central bankers, not just here in the US, but around the world. But I'm interested in their thought processes. And the first thing that has to be said is that none of them have any, with a few exceptions, because they're kind of Austrian school guys. And their Austrian views, by the way, are on their own time and in their own personal opinion. The views of their banks definitely aren't. But at the more senior levels, there's no interest in gold. There's no understanding of it. There's no expectations around it. There's no, oh, well, we all know that we're destroying our currencies, and so we're all going to privately stock up on gold, and then when everything blows up, we're going to be the rich fat cats. There's none of that thought process. Whatever you can point out that's going on with their currencies, they all have these glib answers that, as far as I can tell, they believe, they're smoking their own stash, I guess.
This is Mining Stock Education, and I am your host, Bill Powers. Thank you for tuning in. If you'd like to engage the show, you can email me at bill@MiningStockEducation.com. Well, silver and gold have been roaring, even as the average worker has been in their house under lockdown in much of the world, including the United States and Michigan, where I live. Yet, even as unemployment numbers are going through the roof, I'm looking at my finance app, and the Dow and the S&P seem to not care that the economic engine of the United States isn't roaring like it has in the past. Well, I reached out to an expert when it comes to the Federal Reserve, precious metals, and the economy, Mr. Keith Weiner, actually Dr. Keith Weiner. He's the CEO and founder of Monetary Metals. You can find more information at monetary-metals.com. Keith, thanks for coming on Mining Stock Education to provide your commentary. And I'm wondering, as I look at the landscape of what's going on in the macro situation, do you think the Federal Reserve can actually save the economy?
Hi, Bill. Thanks for having me on the show. Can the Federal Reserve, which is the central planning agency, save the economy? I'll give the too long don't read version, no. And follow that up with, it should be clear, and when I say clear, I mean like to a sixth grader who's at all intelligent or thoughtful, that in order to consume something, you first have to produce it. If you go to the grocery store and you buy a can of Coke or a steak, right, somebody has to work to produce that. And the whole premise of having a central bank is that somehow we can boost wealth and the economy and hence consumption, by so-called money printing. But that's a contradiction. That would seem to violate what any sixth grader would know. You can't. And so it turns out what the answer is that even if you're not producing more and the central bank somehow engineers it so that you feel wealthier and you consume more, you are consuming something that was previously produced. It's just not produced by you. And so we have a term in economics for when people produce something and then they save and accumulate it. It's not meant for consumption right away. It's meant to ultimately enhance future production and hence increase future consumption. And that's called capital or capital goods. So the only thing the Fed can really do is find ways to engineer the conversion, and I use that word knowing that there's a legal overtone to conversion. It's like an illicit taking of property. It's engineering a conversion of capital that belongs to somebody, converting it into income to be received by somebody else and then consumed. And so the Fed, has been good at engineering that, and they've developed a whole, they would call it toolbox. I guess maybe a better word is bag of tricks for doing that. And so that's what they do. And then people say, oh, yay, the economy has been saved and GDP is up. But at the root of it, it's always finding a way to convert capital to income to be consumed.
Keith, I was speaking with a friend who is a fiscal conservative and an investor and who believes in capitalism, but he commented to me that he thinks it would have been better for this situation if student loans would have been erased and they would have gone the path of a cancellation of debts rather than issuance of new money. What are your thoughts here?
Most people, when they talk about canceling student debts, are not really talking about dealing devastating blows to lenders. They're talking about the government forgiving it. In which case, it isn't really canceling it. It's just shifting it from the student's balance sheet to the government's balance sheet, just onboarding the debt and saying, well, now the government will owe it. So, it's like there's a lump under the rug, and you were all debating whether it's better to have the lump, on the left side of the rug towards the TV rather than on the right side towards the sofa. And, which side of the rug is better for the lump. And when you see it that way, then you realize, wait a minute, is either side really better?
Do you think the U.S. dollar will survive this crisis?
Yeah, I think, okay, so my view is all irredeemable currencies are guaranteed to collapse in the end. And people use the word fiat. Fiat means force, and yes, this is a fiat currency. But economically, what's important about it is that it's irredeemable. And so what irredeemable means is that you can't go to the bank with your $20 bill and cash it in and get money out. The note, which is the word for credit, stands for itself and isn't redeemable anymore. So we pay debts using this IOU, using this debt. And so you can never extinguish a debt, and that means the debt must grow exponentially. It must grow every year by the accumulated interest. And so at the end of the day, the debt is growing faster and faster and faster, and at some point it consumes everything. So in the 2016, in the lead up to the 2016 election, I said, assuming that Trump is in office for 8 years, they'll call him 20 trillion Trump. And that would be true for anybody in office, by the way. It's not a particular criticism of him, although he seems to embrace it with abandon. But that the debt is doubling about every 8 years. And so we now see with a baseline deficit of the 12 months ending March 31 of about $1.7 trillion. That's the baseline. And there's a great website put out by the U.S. Treasury called Debt to the Penny that you can put in whatever dates you want, and it'll show you the debt every day. So a baseline deficit of 1.7 trillion. Then they passed the CARES Act, which is another 2.3 trillion of spending on top of that. Then there was a supplement to the CARES Act. I don't even know what they called it, but it was $0.5 trillion. So we're at $4.5 trillion of deficit, and that's assuming that they don't do any more, which everyone knows they will. And no one's asking the question yet how much tax revenues have dropped. Let's estimate $1 trillion. So we're looking at a $5.5 trillion deficit before they spend any more, which they will. And so obviously that's not hard to add up to 20 trillion in 8 years if you're doing $5.5 trillion a year. So absolutely all these paper currencies are going to come to an end. That said, they come to an end when, I think it was Margaret Thatcher who said the problem with socialism is eventually you run out of other people's money. So this process of what people call money printing, which I call borrowing, is a process of consuming other people's capital. And the system or the whole thing collapses when you run out of other people's capital. So in the United States, we're not running out of capital yet. And because the way the world's monetary system is wired, people in the rest of the world are eagerly putting their capital into US dollars. They don't understand this in these terms, of course, but they're donating their capital to continue it. And so what's going to happen is all the other currencies will fail first, and then the US dollar will fail in the end. So I don't think the current crisis is the failure of the US dollar, but at this point I would start to look at peripheral currencies for signs of failure. There's no question that what's happened, and I mean the response to the virus, has been enormously destructive. But I don't think the dollar comes to an end just yet.
We'll be right back after this word from our sponsor. Austrian Resources is a junior exploration company with the appetite of a major, focused on finding the next globally significant discovery to create enormous potential upside for shareholders. It's one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. With Austrian's unparalleled technical team and highly experienced management with a history of success in advancing and monetizing exploration assets, Austrian has been called one of the best in the junior exploration sector. Austrian trades on the TSX and NYSE under the ticker AUG. To learn more, go to AustrianResources.com. That's AURYN Resources.com. As you know, there's been a lot of talk in the precious metals community over the years of the stockpiling of gold with Russia and China, and perhaps the BRICS nations are plotting to overthrow the dollar. So I take it you don't think that'll happen because you said all the other currencies will fall first and then the US dollar falls?
Well, that, yes. And part of the reason why I say that is all the other currencies are dollar derivatives anyway. So, it's like saying that, a call option on Google would survive the collapse of Google stock. I mean, how could that even be possible? If the Google stock collapsed, the call option would collapse long before that. So,
but if another nation converts their currency into physical gold, would that change the landscape?
It's that. Let me try to take a step back and answer that a different way by looking at as the world came out of the Middle Ages, banking started to develop, and banking and credit was a key force that enabled us to climb out of a very dark period of history. What banking, did was it asked people to extend trust, and trust is the key component of credit. The bank said, okay, give us your gold, and on your behalf, we're going to lend it, and and in so doing, enable increases in production, so everybody becomes better off as we start to finance, or they started to finance things, and of course the depositor would get interest on it, or in the least case, they would get paper banknotes that were more convenient to handle and carry and weren't subject to wear and tear, and had convenient denominations, 1, 2, 5, 10, 20. So it's a people bringing their money to the bank and giving, extending trust and getting credit, and that has to be an organic process. So what governments did, in some cases in the 19th century, in other cases in the 20th century, and obviously it's very well understood in America what the Fed did, and what FDR did. President Roosevelt in 1933 said, okay, we're taking all the gold away from everybody, and we're making the dollar, which had been a claim to gold deposited, we're making the dollar now a claim against nothing. The dollar isn't anything anymore. It stands for itself. It's a self-referential, circular argument. But the trust and the credit was still there. Everybody was trapped in it, but they didn't have any reason to lose faith in it, obviously, and they didn't in the 1930s, 1940s, and so on. But today, all of these currencies are pure irredeemable. They don't represent that extension of gold credit. You can't retroactively declare, okay, well, from now on, a dollar is, $2,000 represents 1 ounce of gold, or $1,000 or $5,000, name whatever number you could. You can't retroactively declare the dollar to be redeemable in that, because no dollar began its life as the borrowing of that. And so all that would do would be a retroactive change of the rules of the game. So first of all, it would be a giant lobbying battle with all the creditors lining up on the one side demanding a low price of gold, which is counterintuitive. But think about that for a minute. If you owe me $1,000 and I lobby the government and say that the gold redemption value should be back at its historic level at $20 an ounce, then that means you have to pay me 50 ounces to get out of debt, which is an enormous sum, and obviously a lot more than the $1,000 you thought you were borrowing in the first place. On the other hand, all the debtors line up and say, no, the price of gold should be $100,000. So then you can give me 1/100th of an ounce, which is a little fleck of gold, smaller than your pinky fingernail. So that would be the first problem with it. But the second problem is when governments try to engage in a price-fixing scheme, and that's what this becomes, it's just fixing a price. The dollar isn't gold, it isn't a gold credit, it's something else. It's a price-fixing scheme. And so when you get the price wrong, depending on in which direction your error lies, you get either crazy amounts of deposits, as everyone says, wait, really, you're going to give me $100,000 for every ounce of gold? And now I can go out and I can go shopping and I can buy Ferraris. I can buy a Ferrari for 3 ounces of gold. Great. Or if you set it in the other direction, you say, well, it's $200. What you just get is a run on the bank, and everybody will withdraw. And so, that becomes particularly dangerous because the value of the dollar in gold terms is not only falling over the long term, That's uncontroversial. Everyone can see that on the graph. But it's nonlinear and it's unstable. And when it gets to a certain point, the dollar will begin collapsing against gold, not against consumer prices necessarily, but against gold. And whatever price they fixed for gold, when the dollar begins to fall way below that, you'll just get this enormous run, which is what was happening in 1933 in the first place. And then they're going to have to abandon their peg. So it just becomes like the Banana Republic banks declare a peg against the dollar, and it lasts only for as long until the market really wants to test it, and then they're forced to abandon. So no, I don't think any of these governments can just declare a gold peg.
So then do you not subscribe to Jim Rickards' theory of $10,000 gold and how this might play out?
Well, I think it's a matter of time before the price of gold hits 10,000 and more as the paper currencies collapse. And the dollar collapses, it will be worth less than 1/10,000th of an ounce of gold at some point. But not because a bunch of countries are getting together to plot anything. One thing I'd like to say is that I've met a number of central bankers, not just here in the U.S., but around the world. And I try to keep lines of communication with them open where that's possible, and they know my work, and they either agree or disagree. But I'm interested in their thought processes. And the first thing that has to be said is that none of them have any, with a few exceptions, because they're kind of Austrian school guys. And their Austrian views, by the way, are on their own time and in their own personal opinion. The views of their banks definitely aren't. But at the more senior levels, there's no interest in gold. There's no understanding of it. There's no expectations around it. There's no, oh, well, we all know that we're destroying our currencies, and so we're all going to privately stock up on gold. And then when everything blows up, we're going to be the rich fat cats. There's none of that thought process. Whatever you can point out that's going on with their currencies, they all have these glib answers that, as far as I can tell, they believe, they're smoking their own stash, I guess.
Masters of the universe?
Not even so much that, but more like technocrat, dirigistes. That, we have this formula, we have this incantation, it's Eye of Newt and the Midsummer's Eve, and and we have a Taylor formula, and we have this equation, and it tells us that, we have to increase the money supply by this to get the inflation rate here, and inflation trades off against unemployment according to the Phillips curve. And, they have all these rituals they go through. And you can point out certain things, and if it doesn't fit their theory, it doesn't exist in their world. And one of these things is that everybody's understood, or at least, I shouldn't say everybody, the economics world was aware that the price level does not correlate with the quantity of money. It correlates with the interest rate. And this goes back to work by Knut Wicksell in the 1890s, who, by the way, was a monetarist and believed in the quantity theory of money, but he did the research and he was careful enough, and he found the relationship didn't work the way he thought it did. And then later, they called it Gibson's paradox. Why do they call it a paradox? It's pretty simple. There's nothing paradoxical about it at all. But and I just use this as an example of when something challenges somebody's mental paradigm, they reject the thing that challenges it rather than their paradigm itself. And the central bankers just don't have any particular view on gold, other than they might have a directional price view. They might think gold's going to go up, and so then they buy it like anybody else buys it, and for the same reason. They think of it as an investment. And of course, in Russia, they had an additional incentive, which was, for a while, it looked like politically what they were doing in the Ukraine might result in the U.S. locking them entirely out of the, SWIFT banking system. And so, like Iran is locked out. And so for Iran, it's very difficult to make payments or receive payments in the world markets. And so, there might have been some thought, okay, well, we have to have gold because we can always put gold on a plane and pay for anything we want. But it wasn't a ideological thing, and it wasn't a monetary thing. It was just simply, that's the practical reality of invading Ukraine, pissing off the United States, and okay, well, this is how we're going to work around whatever they do to make our life more difficult.
Keith, how does oil factor into all this? Oil is often referred to as black gold when we're talking about the currencies of these nations and how it's related to gold. How do you see oil related to the currencies of all these nations?
So, in terms of Russia, Russia was a net buyer of gold as long as the price of oil was holding up. And when the price of oil went to its, I have to call it an epic collapse. There's been two epic collapses of oil, one in 2014 to 2015 and one in 2020. Russia becomes a net seller of gold, or at least not a buyer, because they don't have the income anymore. And they may even have to liquidate that gold in order to keep feeding the people. If you can't feed the people in an authoritarian regime like that, then you have regime change. And I'm sure that Putin must be thinking about that. But more broadly, oil and gold, something happened a couple, 3 weeks ago, and I wrote about this at the time. The price of oil went negative. And so it's kind of a weird anomaly with the futures market. But in short, we've had all of this stimulus over the past 10 years, 12 years, right, since 2008, 11 and a half years, I guess, in the form of low, zero, and falling interest rates. And what that does is it overstimulates overcapacity. If you're a business manager, let's say you're in the oil business, but whether the hamburger business, clothing business, or the computer business, it's always the same calculus. You always think, okay, I could build another factory and increase production. And okay, how much am I going to make if I do that? And you have your numbers and you plug them in. And then it always comes down to cost of capital. So every time that the central bank is lowering the cost of capital, it's tilting the equation more and more in favor of increasing capacity. So that's what we did. We overstimulated overcapacity in oil, particularly in fracking. And we produced more and more of this oil. Okay, great, consumers love it. We can drive big gas guzzling SUVs and all that. And I don't complain about that. I drive a Corvette Z06, so it's got a big V8 in it, and there's nothing wrong with that. But the price of oil, you lock down the world, and you say that so far, 33.5 million Americans can no longer be employed, so they're not driving to work. Most of the rest of the people who are employed aren't driving to work either. They're working from home. And you can't drive to the sports game. You can't drive to the concert. You can't drive to the restaurant. You can't even drive to weddings, visit friends, etc. So, driving and travel has collapsed. I mean, airline travel is down, 90%. I don't know what it is. It's got to be huge. So we're burning less oil, right? That's just a consequence of the lockdown. So all of a sudden, you have a situation where the oils continue to be produced. That oil was all bought long ago on futures contracts, and now that when it comes to delivery time, this is that technical thing in the futures market. If people want to speculate in oil, unless you have a giant tank somewhere, you got to do it in the futures market. So you buy a futures contract, and you think, okay, well, if the price of oil goes down, I lose. If it goes up, I win. I can always sell it. I'll cash settle my futures contract because I don't have a truck that can take 1,000 barrels or 40,000 gallons of oil. I can't take delivery of that. So all that oil, all those speculators who own the oil futures contracts have to sell. And meanwhile, more and more oil keeps flowing through the pipeline, but demand has collapsed. And so it got to the point on one day, I don't remember what day that was now, about 3 weeks ago, I think, when the price of the June futures contract hit minus $38. You had to pay somebody to take the oil. And whatever else one might say comparing oil to gold, there will never, ever, ever be a situation in which you have to pay somebody to take your gold. But it did just occur in oil, and as we see for different reasons, what the government has done to the supply chain in meat, the ranchers and farmers are now being forced to destroy animals. And so effectively, there's a negative price, and the animal keeps eating. So there's a negative value on meat. There's a negative value on oil, at least there was that day. So all these other commodities, never gold and silver, but other commodities, we find there can be, under the right circumstances, a negative value to it.
Keith, your website is called Monetary Metals. What metals do you consider monetary?
Gold and silver.
Not palladium or platinum?
No, they're expensive industrial ingredients. Maybe they're pretty and maybe people like them, and that's not really the argument. But money is money because of what's called a high stocks to flows ratio. That is, in the case of gold, the case is the most obvious and clear. We've accumulated virtually all of the gold ever mined in human history is still in somebody's hands. I mean, a little bit is worn away as the coins rub in people's pockets. Some of it's lost when ships sink. Some of it was buried with people who had gold teeth, although the grave robbers usually recover that eventually. So, all the gold over maybe 5,000 years of human history is still in human hands. And so that amount of gold as a total stocks is a giant multiple of annual mine production. So according to the World Gold Council, what is it, 180,000 tons of gold is the total stock, something like that, which I think has to be a big underestimate because you can't inventory it because people have been hiding gold from their neighbors and their governments for 5,000 years. And you divide that by annual mine production of 3,000 tons or something like that, and you end up with, according to that estimate, which I think is low, stocks to flows in gold is 60 years. In oil, it's a couple, 3-4 months, and anything more than that, the price goes negative. And so gold and silver both have this enormous accumulation of inventories that has occurred over many, many thousands of years. And no other metal is remotely, or no other commodity for that matter, is remotely close to that.
We'll be right back after this word from our sponsor. Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. One question on silver before I'm going to ask you to explain a little bit more about what Monetary Metals offers. When do you expect silver to really start performing like a monetary metal? Because right now it seems like it may be hinting like it's going to perform as a monetary metal in this crisis, but I think that it's primarily been performing as an industrial metal.
Yeah, and I agree with that. And obviously the industrial component of silver has collapsed along with, oil and everything else. But the monetary hasn't. But I think you have to look at the question, why are there two monetary metals? Markets tend to be winner take all. Coming from the technology business myself, I always look at early technology contests. And so when computer networks started to become a bigger thing, you had so many different kinds of networks. You had Token Ring from IBM, you had Ethernet, and so forth. And at the end of the day, TCP/IP won, and everything else was obliterated. But we have two monetary metals, and they've survived for, as far as we know, 5,000 years, something like that. Why did one not displace the other? And I think the answer is they serve slightly different markets and slightly different purposes. So gold obviously has always been, as they say, the money of kings, wealthy gentlemen, big merchants, and so forth. Gold solves the problem of how to carry value over great distances. And so today, the reason why gold is so liquid is you could put it on a plane from anywhere in the world to anywhere else in the world and get it there in less than 24 hours. And that's, settlement in the gold industry is T+1 or T+2 anyways. So if there's a relative shortage in Dubai and a relative surplus in New York City, it gets on a plane and it goes. Silver, on the other hand, serves the purpose of carrying value over great amounts of time, and particularly for wage earners. So if you are working for wages in a skilled labor kind of thing, and you want to set aside 10% of your weekly wage, that might be $50 or $80 or something like that. That's not terribly convenient in gold. It doesn't give you like a handful of gold, it gives you a very small fleck of it. And it's an inefficient way to do it because you pay big premiums for tiny little pieces of gold like that. I mean, you can buy a 1 gram bar, fleck or whatever you want to call it, wafer, I guess, for about that much money, it's not much to hold. Doesn't feel exciting, and there's a big premium in the manufacturing of something that small. Silver, on the other hand, $50 or $80 of silver is a handful of silver rounds or silver coins. So silver tended to be accumulated and hoarded by wage earners, and gold tended to be by the capital owning class. Well, if you look at what's going on in the world today, the wage earner is under ever greater pressure, and that's a topic I've been writing about for a decade or so. And the class that owns capital assets is enjoying, at least for now, the boost provided by the Fed. And so the wage earner may be forced to, not only isn't able to buy more when he loses his job, he may be forced to sell to put food on the table. And the capital class right now is feeling pretty smug with, there was a dip in the stock market, but things seem to be recovering as far as they're concerned. And so that's why you see these two metals performing very differently. And of course, we've hit, as far as I know, an all-time record that the world has never seen before of a gold to silver ratio of, well over 110, briefly touched 120. I think that will turn around. And I think that ultimately, even institutional investors who normally turn their nose up at silver are turning to silver in some cases because they see the relative bargain. As to when, that's a bit of a guess.
And as listeners go over to monetary-metals.com, what does that have to offer?
We pay interest on gold and silver. So, the mainstream view is that, you buy gold or silver, it's a dry asset, but its price will probably go up. And certainly in this environment, I think it's realistic to expect the price will go up. But it's a dry asset that isn't doing anything, and you're paying for storage in the meantime. We want to bring about the gold standard, first of all, and we're pretty open about that. And we believe that to do so, it has to be possible for everybody who wants to earn interest on their metal. And we see the monetary metals as the appropriate and best means of financing productive activities. So we are open to the public to deposit metal and get a return on it of between 2 and 4.5%. And that's metal on metal. So if you have 100 ounces of metal and the interest rate is 3%, the next year you have 103 ounces.
Did you ever propose that to Warren Buffett? Because, that's one of his objections for not investing in gold.
I don't happen to be privileged to be in his inner circle to suggest that to him face to face. We did write an open letter to Warren Buffett and we talked about that. Whether he's read it or not, who knows. It's an idea that if this was pre-2008, it would have been the wrong time, and I don't think we could have been successful in this business. Post that world, the perception of the precious metals has changed, and it's a sea change. People don't think the way they did in 2007, and now post-coronavirus, we see a big uptick in interest in this stuff. And just like in 2008, 2009, a whole bunch of people came as first-time buyers to gold who never had it before. There's a whole nother round of first-time buyers in 2020 as more people are, dare I use the term, waking up. I think if you're a mainstream conventional person, there's two things you can see that don't require any doom and gloom or gold bug kind of stuff. And one is the size of the federal deficit. It just can't feel good to be, an owner of their credit paper when you see that kind of abuse. It just has to be uneasy to anybody, no matter how Warren Buffett-y you are. You have to feel uneasy about that. And then number two, the interest rate, which is your reward for taking. So the risk is going up with all that borrowing, but the interest rate, which is your reward for that, has collapsed. And so in fall of 2018, you could get 3.2% on a 10-year Treasury bond. That's a pretty good deal. But this winter, as recently as this winter, it was 1.8%, which is still something. And then in March, it collapsed to 0.5%. And now it's been banging around on that, new floor. So, was it 0.6% today or something, or 0.7? They've taken away the reward at the same time they've amped up the risk. And I think a lot of people can see that. And as they start to ask themselves the question that everybody has to ask before they start buying gold, what's my way out? Can I opt out of this? This is madness. And then gold comes to mind. So we're saying, okay, if gold is money, which we believe it is, money should earn interest. Warren Buffett is right, disingenuous, obviously, in the way he was trying to frame it, but he's right that money should earn interest. And so that's our unique selling proposition, that's our vision, to bring about a change for the better, a change to the gold standard by making it profitable for investors to move us in that direction.
And I'll put a link to Monetary Metals in the show notes. Website again is monetary-metals.com. You've been listening to the CEO and founder, Keith Weiner. Keith, I really appreciate your insights on the economy, Federal Reserve, gold, and everything that's going on. Thank you for joining me on today's show.
Thanks for having me.